Blue Limited, an all-equity finance company, is considering the repurchase of 275 lakh equity shares and to replace it with 15% debentures of the same amount. Current market value of the company is 1750 lakhs with its cost of capital 20%. The EBIT is expected to remain constant in future years. The company also has a policy of distributing its entire earnings as dividend. Assuming corporate tax is 30%, we have to calculate the impact on the following on account of the change in the capital structure as per the Modigliani and Miller approach. Now you need to remember, according to the Modigliani-Miller approach, we have a formula for the value of a levered company, which is equal to value of unlevered company plus tax benefit. Alright, that's one thing you need to keep in mind. Second, when we calculate market value of equity, okay, the market value of equity is equal to the net income, or what we call earnings after tax net income upon KE. Over here, they have told us that the current market value is 1750 lakhs and the cost of capital is 20%. Now I know that this is KE because they have told me that it is an all equity finance company. So I can literally do this. 1750 is equal to net income, which I do not have, upon KE, which is 20%. And now solving for net income, I get net income is equal to 1750 into 20%, and you all can do the math on the calculator. I'm also going to do it now. Okay, so I'm taking 1750 into 0.2, 20%. Okay, I get 350. Right, so I've managed to get the value of the company before it goes in for raising debt. Now, once it goes in for raising debt, we need to calculate the value of the levered firm, which we know is the value of an unlevered firm plus tax benefit. Now, I'm going to substitute it here itself. The value of the unlevered firm we know is 1750. Okay, but there is a tax benefit now because 275 lakh rupees worth of equity shares have been replaced or are going to be replaced with 15% debentures. So this much worth of debentures have been, and the tax shield is going to be 30% of this number. Okay, so you're going to take 30% of 275, which gives us 82.5. Okay, so that gives us 82.5, and that is the number we end up putting over here. Right, and putting that on the calculator, this number plus 1750 gives us 1832.5. 1832.5, and then we go ahead and calculate the change in market value, because we have been asked to calculate the market value of the company which we've been able to do using the formula. Do we really need to calculate the change in market value? If at all, you can really identify it over here. Okay, the change in market value is nothing but this. Now, why under this model do we have no change in the value of equity? Because that is the formula for the model. The value of a levered company is equal to the value of an unlevered company. Okay, the value of an unlevered company plus the tax benefit. Okay, and that's what gives you number. Anyway, going forward, we are done with part 1. Okay, part 2, they want us, okay, so part 1 is effectively done here. Part 2, they want us to calculate overall cost of capital. Now you need to keep in mind that we are redeeming shares. We are buying back shares through the issue of debentures to the tune of 275 lakhs. So how many shares do we have? 1750 lakhs. How many shares are we buying back? 275 lakhs. What are we issuing instead? Debentures. So that changes the capital structure of the company. Alright, so when you think of your original 1750, okay, when you think of your original 1750 in terms of equity shares, that was the value of the company before you went in for a debenture issue. What happened to the value of the company after going in for a debenture issue? We got a value of 1832.5, and it is out of this value that we are now able to buy back some of the shares. So 1832.5 minus 275 will give you your equity in the table. Okay, so we have source, we have amount, we have cost. Okay, and before we go in for cost, better to have proportion. Proportion, cost, and weighted cost. Okay, and we can go ahead and make the table on it. It's always a good idea to draw the lines first before writing. Alright, so as far as our sources are concerned, there are only two. We have equity. Okay, we have equity and we have debt because we have issued those debentures. Alright, so going back upstairs, we have a value of 1832. We have issued 275 worth of debentures. So we take 1832, 1832.5 minus 275. Okay, and that gives us 1557.5. 1557.5. Then what about debt? We know how much of debt we've issued. We've issued 275 lakhs, so we simply put 275 lakhs. Okay, as far as the cost of capital is concerned, for debt it is very straightforward. Okay, we have a certain rate given to us in terms of interest. Okay, 15%. But remember, it is I1 minus T. So we are talking about 15%. Okay, into bracket 1 minus 0.3 tax. Okay, so I'm going to do that. We have 15 into 0.7, which gives us 10.5. Okay, so getting the cost of debt is easy. Now we need to think about the cost of equity. Alright, and the cost of equity at the end of the day is the income the company is able to generate. Alright, and do we have that data with us? No, not yet. We are going to have to make the table now. Alright, so we have avoided doing it till now. Now's the time to make it, and I'm going to do it over here. Okay, I'm going to squeeze it in over here. Right, so we have particulars, the situation with only equity, again the situation with equity and debt. So only with equity you have EBIT minus interest gives you EBT minus tax, okay, gives you net income or EAT, potato. Now, in the last time around, they told us that the company is having a market value of 1750 lakhs and making a 20% return. Okay, so why 20%? Because the cost of equity is 20%. So we're going to take 1750 into 0.2, which gives us 350. Okay, and that is the 350 we keep downstairs over here, and we work ourselves backwards. And by the way, we actually know what the tax rate is, which is 30%. Okay, so this is 30%. Assuming this is 100%, that means this is 70%. And now we are in a position to cross multiply. So it's going to be 350 into 100 upon 70. 350 into 100, okay, upon 70, which gives us 500. And this is going to be 150. Yeah, 500 minus 150 gives us 350. This is 0. This is 500. Okay, and therefore we know that this is 500. And we have interest this time around. It's going to be this number into the rate of interest, which is 15%. Okay, so we are going to take 275 into 0.15. 275 into 0.15, which is 41.25. Okay, so we take 41.25, and it's going to be 500 minus the sum. So I'm just going to do minus 500. Okay, so we get 458.75. 458.75, and this 458.75, I'm going to multiply it into 0.3 to get tax. So 137.625, 137.625. Okay, and now we subtract it from 458.75. So 458.75, and we end up with 3 to 1.125. Okay, so 3 to 1.125. Why am I sticking to so many decimals? Because these numbers are in lakhs. Anyway, what we've been able to do is we've been able to isolate the net income under the second approach, and the formula for KE does not change. Okay, the formula for KE remains exactly the same, and this time around the net income is 321. Okay, so we just need to rearrange this one formula. Okay, remember, originally formula for cost of equity can come from what we saw upstairs. Okay, so we know that the value of equity is equal to net income upon cost of equity. But what happens when we know the value of equity? We know that the value of equity is 1557.5. Okay, so I'm just going to go ahead and imply that 1557.5 is equal to the net income that we saw upstairs, so 3 to 1.125. Okay, 3 to 1.125 upon KE. And now solving for KE, it is 3 to 1.125 upon 1557.5. Okay, so it is going to be the same number upon 1557.5, which gives us this, and of course into 100. Okay, so it's 21 point, this is 5 or more than 5, so 21.62%. 21.62%. Okay, which is what I can then go ahead and put over here, 20. Okay, and I hope I've written that correct. Be careful. Okay, it's 20.61. So 20.61. So going back upstairs, the cost of equity calculated as 20.62. Okay, so 20.62. Now we multiply proportion into cost. Okay, so these two into these two to get numbers here, and the total will give us WACC. Alright, so we are going to multiply 0.85, okay, 0.85 into 20.62, which is 17.527. Okay, so 17.527, 17.527, and then 0.15 into 10.5, 0.15 to 10.5, which is equal to 1.575. 1.575. Okay, and now adding both of these, we get 17.527 plus 1.575 gives us 19.102, okay, or 19.1. So our WACC is 19.102%, and we're just saying WACC is 19.1%. So that gives us our overall cost of capital. Now, as far as cost of equity is concerned, coincidentally, in order to solve for this, in order to solve for part 2, we have unwittingly, unfortunately, solved for part 3. Okay, they are asking for KE. Our KE is 20.62%. And we need to comment. Keep in mind the original KE in the unlevered form. Okay, so KE as far as the unlevered form is concerned, that value was 20%. Okay, so I'm just going to do like this. There are formulae to recalculate, and you'll get the exact same thing when you have it. Why to bother? Okay, so we have 20.62%. Originally it was 20%. So we have to say that the overall cost of equity, okay, equity has increase in cost of equity by 0.62% because of higher debt. Okay, don't bother with any other formula, not required. Okay, what we have done till here is the sum. If you have any doubts, feel free to comment. Thank you.